Monday, February 23rd. It's 4:04 p.m. We got to take a roll. You can take the roll first.
No, that's okay.
Good. Okay. Do we have any public comment?
No.
Okay. So the next item here, Agenda 2, is the approval of the minutes dated August 14th of 2025. Has everybody had a chance to review those minutes? Is there any discussion, any questions?
I'll make a motion to approve.
Motion, got a second?
Second.
All in favor?
Aye.
Any opposed? Okay. Motion carries. Agenda item number 3, we've got a review of investments with Marquette. So, Mr. Tim, take the floor for us.
All right, thank you. Afternoon, everyone. Let's see if
He gives, just give it a second.
I press the magic button. Okay. I'll follow my normal format. We'll talk about the markets for a few minutes. I won't pontificate too much. I really don't know what's going on with a lot of it, with tariffs and all the rest hitting the market again today. We'll go through the performance of the report. It's the portfolio itself. We're up to about $82 million, so that's a good sign. And then we'll review the investment policy briefly, looking to review that and then potentially approve it. So just looking at the market itself, here we go. Our information is through January. So January's on the left-hand side. That's this 2026 year-to-date. 2025 is on the right-hand side. U.S. stock market is on the top, the various indexes, non-U.S. internationals in the middle, and bonds are on the bottom. Obviously, 2025 was a great year, an excellent year for pretty much everything. U.S. markets are up, 15 to 20%. International was up close to 30%. And bonds actually had a good year as well, up 6 or 7. So the marketable asset classes performed very well. Here in January, you're seeing somewhat of a shift. Markets are generally, as if you look at the markets as of, when the market closed today, basically flat year to date. The S&P is about up, probably very, very close to zero because it was down about 1% today. What we're seeing is a shift. The Mag 7, the technology, the AI, the NVIDIA, Microsoft, Apple, those are pulling back. After 3 years of performing extremely well and really carrying the market, those stocks are not. The market has sort of shifted from these AI companies that are going to be supplying and building it and looking at the other industries and saying, where's AI going to help and where's AI going to hurt? AI disruptors is the term apparently that people are using. So that has brought a lot of volatility into the marketplace, but the drivers, again, the tech, which we've been really just following and enjoying the last 3 years, isn't doing quite as well. International stocks continue to do well. You have a 10% allocation. Right now you're close to 12% in actual. I'll show that in a minute. You have a 20% limitation per your investment policy for all of your international assets combined. So you stay within that, but that's really been the driver. Not last year, but also so far this year. The best area of the market through today, year to date, is emerging markets. So a little bit different. From an economic perspective, the one area that the market itself, the financial markets are the most concerned about is jobs. This chart shows job growth month over month for the last 5 years. The tan bars are the net jobs added each month. And I boxed out just 2025. And now we've had revisions since this chart came out. Essentially, the second half of last year, the U.S. economy didn't add any jobs at all. We're supposed to add about 170 to 200,000 jobs a month. That's a well-functioning, well-performing job market. We're not getting that at all. Last year, if you strip out healthcare, there actually was no job growth last year. So we fell more than 1.5 million jobs short. So that's the concern. That's the reason in part that the Fed was able to lower interest rates twice last year and is looking at twice this year. It's not necessarily from an inflation perspective. It's they need to get this economy moving a little bit. And it's the other challenge with the jobs is it's impacting lower income households more than higher income households. Higher income households' wages are still growing. The job market itself is still decent. But for lower income households, this is what you hear a lot about, the K economy. Some people in my world throw that topic or that statement out right now. A K with somebody's going up and somebody's going down. Here's an example of it. So higher income households' wages are going up. Lower income households' wages have been going down in half for the past couple of years. And wage growth is getting actually very close to zero. So that's from an economic perspective, what the markets are concerned about is how much is AI impacting this? It definitely is. In terms of bonds, interest rates, the green is last year, the blue is this year. So short end of the yield curve, short-term interest rates, what you get on your savings account, have been going down over the past year. That's what the Fed has the most impact, direct impact to decide. There's a little bit of a lip there, if you will, on the short end on the left-hand side, because the market's already priced in essentially two Fed cuts rate this year. Not exactly sure when they're going to happen, but that's what they've priced in already. What they haven't priced in, and what the challenge is the long end of that yield curve, which really hasn't moved much. It's just now in the past couple of days it has. Again, tariff conversation actually changed the yield curve itself, but that's the part of the yield curve. Those are the interest rates that the federal government is most interested in right now, because we're issuing obviously $38 trillion in debt. They're right now issuing a lot of short-term debt because the longer end of the curve is higher than they want it to be. So the new Fed chair is walking in with, let's not call it a mandate, but a suggestion that he gets those longer-term interest rates down. As we know, the stock market's been doing great. Last year, on a cumulative basis, the S&P's up 78.3%. So if you put $1 in the market 3 years ago, as of January 1st, you had $1.78. The expectation, average consensus estimate out there, and this was at the beginning of the year, was that the market's going to be up another 10% this year. So on a cumulative basis, bring it up to almost a double, to 97. I'm the consultant, so I'm supposed to tell you about the downside. If the market goes down 5%, 10%, 15%, what we're showing there is the cumulative 4-year return of the market's still very good. But again, that's not the consensus. Consensus is another 10%, although again, as of this morning, it's flat. I talked about a market shift kind of taking place, tech not leading the charge. Small cap stocks have rebounded in the past couple of months. Siegel Bryant's the manager who does it here for you. They were probably the one manager, I would say, that significantly underperformed last year. They underperformed because unprofitable companies did well in the small cap market. That's changing right now. And that's why when the line is heading upwards and above the zero, above the horizontal axis, that's when small caps are outperforming large caps. And that's what we're seeing right now. Again, it's a shift. The kind of the big Mag 7 Apple NVIDIA trade is sort of over, at least for now. But the money is not leaving the markets. It's going into other areas of the market. So it's going into small cap, it's going into international, it's going into value. You have exposures to all of those. So that's a good thing. I mentioned these AI disruptors, and so the market, in all its wisdom, at the beginning of the year, decided that software was going to be hit hard by AI technology. Think Salesforce. and the fact that this type of software is going to be more easy to replicate on a much cheaper basis and much more widely dispersed. So obviously hindering companies like Salesforce and others like it. So those stocks through the first 5 weeks of the year were down over 20%. This is sort of what the market's doing right now, is it's going through, it does fully believe, and you can see in the numbers, that overall corporate profitability is going to continue to go up the next couple of years. That's sort of priced into the estimates. That's part of the reason why the market's going up as much as it had gone up as much as it has. But now it's looking sector by sector, looking at where AI is really making an impact right now and deciding who the winners and losers are going to be. A lot of this is speculative, which is why markets can move 20% in a sector in a month. It's just some of the hot money, the quick money leaves, these stocks all at once. This is the volatility you kind of have to live with. This is why you're broadly diversified. This is why you're in a bunch of, different categories, different asset classes, even different countries here. As I mentioned, non-U.S., the U.S. is third from the right here. So far this year, even though we had a positive year, we were up about 1.8% in January. That still trails, I think it's whatever it is, 17th of the developed countries around the world. There's definitely momentum, and some of this is just, you can see it in the asset flows. Money is coming out of those technology stocks, coming out of those types of investments, ETFs, mutual funds, and you can see the money moving over to international. So there's some good reasons behind it, some good economic reasons. The stocks are cheaper on a relative basis than U.S. stocks. So there's some fundamental reasons, but sometimes it's just the money is moving. And you can see hedge fund flows, hedge fund managers, crowded trades. They've been moving around, and hedge funds appeared to have taken an interest in non-U.S. stocks as well. And that always kind of moves the market. This is what I mentioned, earnings growth estimates. So this is U.S., international, emerging markets, developed. Over the next 2 years, essentially, everybody's supposed to make more money. So on a corporate level, on a global basis, earnings for corporations are supposed to go up materially the next 2 years. A fair amount of this has already been priced in the market. That's why the market's up 78% in 3 years in the U.S. It's not based on the past, it's based on partially on future. So we have to get those numbers. You have to hit those earnings. Otherwise, you can have an issue. But so far, the indications are that we will. So looking at your portfolio, as of the end of January, the portfolio stood at 82.2 million. The percent of portfolio, the third column from the right here, is actual as of the end of January. Policy percentage is the column next to it. You're in compliance with your policy. There are a couple areas where you're overweight, a couple areas that you're underweight. The two areas that you're really underweight are down here near the bottom in infrastructure and private debt. Those allocations have been made, those subscription documents have been filled out. The managers haven't called the money yet. You went in infrastructure from 5 to 7.5% in August, so we increased the JP Morgan allocation. Submitted the paperwork. They say they may take the money April 1st. They tend to buy multi-billion-dollar assets, so they tend to build up a queue and then take the queue all at once when they buy an asset. So that will go up to 7.5 again, and we're just waiting. And Golub's been a manager that you've had since the beginning. We did a $3 million allocation. They drew $1.5 million. They've made some money. They just came and took 80,000 more. They have said they'll take the full $3 million by the end of 2026. So they've been a little bit slow in taking the assets. They've done a nice job with what they've taken, what they've called, but we're waiting for that one as well. So those are the two that you're underweight. Again, it's not a tactical decision on our standpoint. We're just waiting for the money to get to work. So that's why you're a couple percent over in equities. And a couple of percent over in bonds. We've been waiting for Golub to take that money, and when they do, we'd be taking it from Baird and Shankman. So you're overweight public markets a little bit. That's been a good thing from a performance perspective. You're underweight a couple areas on the alternatives.
Tim, can I ask a quick question?
Yeah,
On that subject?
absolutely.
Should we consider looking at going maybe like 1% over in those timed investments to get ahead of the fact that we know we have large deposits coming?
Yeah, we're going to have to, we are going to start doing that.
Okay.
The first area we're actually going to do that with is in the private equity. We are going to make it a third allocation, an additional manager. Right now, you're in two, thank you, I wanted to bring this up. You're in two private equity evergreen funds. The evergreen funds allowed us to get you fully invested all at once. So you're investing into an established portfolio, diversified over vintage years, types of investments, et cetera. We were able to get the money to work. Now in 2026, we'd like to add a third manager. We're working on it now, figuring out which one matches up with the two that you have. That will be a manager that's closed-end, that's going to call the assets over a period of time. And to your point, we're not going to pull money from anywhere right now. We're going to see when they take the money, so the commitments, when they actually draw the money, versus when you get the additional dollars in. So I'm not necessarily going to put in a redemption at Partners Group or at Pantheon in anticipation of it, because this portfolio keeps growing. So we're going to start doing a bit more of that, where we're a bit overweight, exactly what you said, in anticipation of it coming down over time.
Yeah, I mean, we know we have the big deposit coming
Yep.
every year, so.
Yeah, every July we.
Just forecasting that's coming, the percentage is going to drop because we can't allocate it into these timed investments.
Yeah, the other challenge is, not a challenge, that's the wrong word. You've made a lot of money. So the portfolio is up, what is it, $14 million since you started this a year and a half ago. So that's also made my ratios skew, because we're pricing these out for a 7.5% increase, and I think you've gotten 11 since then. So that's also kind of made the math a little more challenging for us. But yes, we are absolutely going to do that. The three things, really, if you look at this portfolio, and maybe this is a good page. So one, we're going to be looking to increase the infrastructure and private credit, and that's already taking place. We're just waiting for them to call it. Second is we're going to add a third private equity manager, and again, let that grow over the next couple of years. It's going to be a $3 million allocation. So we've sized it out. We did a commitment project to see what the right dollar amount was, but we're not going to necessarily take the money from anybody else right now. We're going to see how this thing grows. And then the last thing, just in the past couple of weeks, we're going to take a look at your hedge funds composite. You've got Parametric, which has done very well, but which is equity-based. The beta, the underlying risk of that hedge fund, is the U.S. stock market. We're getting to the point we might want to split that into two, leave Parametric, but bring in something that's more credit-based, fixed income, and balance that and take a little bit of that equity risk, a little bit of that equity beta out of your hedge fund portfolio. So this is something we kind of talked about when we first started, was we're going to build a base portfolio based on the 50 million. But as it grows, we're going to be adding managers and adding asset classes and further broadening it out. The third private equity manager is an example of it, and then the second hedge fund will be an example of it. As I mentioned, and the number is correct, so portfolio started with about 53 million when it came over, including net proceeds. So you get money each July, but money gets paid out. This was the money just left in December of 2025. I think it was 3.4 million. But net, all in, the dollars that have come into this portfolio so far, about 67.8 million. Again, I know it started before Marquette started, so the dollar amount's a little bit different if you take it all the way back to the inception of the trust. But from our standpoint, from what we can, what we're tracking, it's 67.8. And you've earned so far, realized and unrealized, about 14.4 million. So that's how you get up to the 82.2. How does that equate to a rate of return? That's the since inception number. It's 11.5. It's net of investment manager fees, and that's over the, whatever that is, 19 or 20-month time period. 20-month time period. Again, we tranched into the portfolio per your direction in 2024, so it's been fully invested in 2025. and over the last 12 months, up a little bit more than 12%. As I mentioned, the one manager that if you just go down this inception column, that has underperformed in a material way is the Siegel Bryant small cap. It's completely understandable. Last year, unprofitable companies in small cap world earned a return more than double of profitable companies. So Russell 2000 has about 800 companies that don't make money, believe it or not, aren't profitable, have a net loss, and 1,200 that are profitable. You hire a manager generally to invest in the profitable companies. That's where Siegel Bryant is. That's quality. That's a safer way to invest there. The unprofitables made all the money last year. Again, more than double, up over 75% over the last 9 months of the year. So Siegel trailed significantly, but what's very encouraging is over the last 3 months, so here in January, it's up 5.5. Over the last 3 months, it's up 7. It's starting to outperform again. So we're going to give it some time. We're going to have some patience. But you can see over the last 3 months, I talked about this rotation. Large cap, the S&P is up 1.8. Small cap, the index is up 5.7. They're up 7.1. So a significant rotation from, again, a bit of broken record for 3 years. Large cap tech leading the way. That's not the case the last couple of months, and here it is in the numbers. And international, doing even better, up 8.8. Over the last 3 months and 35.4%. No, I had no idea that was coming. The alternative part of the portfolio, everything is positive since you've invested in it, which is good. Parametric, again, this is the one where we might split it out. Not that they're not doing a great job, but this is, again, an equity return, and they should be doing a good job. If you've got equity risk in a portfolio the last couple of years and equities have performed very well, they should be up. Real estate's up a couple of percent. Now, Ballard has been up now 5 straight quarters, but it's small. It's 0.6, 0.5. It's basically an income draw each quarter. We are expecting better things from that allocation. Infrastructure is doing very well. Again, sort of outperforming our expectations here. JP Morgan, the year and a half you've had them up 10.2%. You'll see some zeros here in January because, again, from Ballard down, they only report on a quarterly basis. So these numbers are through December. So your January's actually will be a little bit better when we get everybody. Golub up 7.3. These are all in green, so they're outperforming Partners Group. And then AMG Pantheon just got started in September of last year, they're going to complement Partners Group. So that's the investment portfolio. Just from a liquidity perspective, again, very liquid. Probably, we talked asset allocation in August, probably too liquid. We reduced the liquidity at 5% at that meeting, putting the extra 2.5% into infrastructure, waiting to get with JP Morgan. Put the 2.5% down in private equity, hired Pantheon to take care of that. So you took, at that point, took 5% from liquid and moved it toward illiquid. I think over the next couple of years, you'll continue to see that. Based on cash flows and other things, we'd rather see your daily down, I think we talked about this last time, in the 50% range. It's still tremendous. You don't need 50% of your portfolio the next day. But you don't need to get too much into alternatives. You don't need to get too illiquid. So it's something based on, through our conversations, fairly conservative nature of the group and what you're trying to accomplish here. We're going to walk into that over a couple of years, unless you tell me otherwise. Surprisingly, managers don't work for free. Their total manager fees are 37 basis points right now. So about 1/3%.
That's almost free.
Excuse me?
That's almost free.
37's cheap. But I said it'll only go up over time with a few more alternatives in there. But having the index funds is, yes. Index funds basically are free at this point. Institutional index funds are, basis point and a half or something right now. So the last piece I have is a review of the investment policy. Because in August you changed the asset allocation, we needed to go back and update Exhibit A in the back. The red is simply what we changed. Equities came down by a couple of percent. Private equity, which includes the private debt, went up from 10 to 12.5. Infrastructure went up from 5 to 7.5. So your complementary structure, that's the Shankman, went from 10 down to 7. And so we took 2.5 from equity and 2.5 from fixed income to get to, so these are the new long-term policy, and then these are the ranges that we managed to. So you, unless again we're waiting for something to get funded, you should never see anything get outside the ranges. The other one, just one other note, I mentioned it before, your international, you do have a hard 20% limit in this investment policy to international, and that's not just international equity, it's everything. So periodically, we pull out the international that's in infrastructure, that's JP Morgan, that's a global fund. We look into Partners Group and Pantheon and see how, there's not much there, but there generally is a little bit. Add it all up and make sure that we're well under 20%. I think last time we did it, you were at 14. So we're going to make sure, that's part of our review, periodic review, is make sure that one in particular. The others are easier for me to track, for us to track at the firm, because you can't have more than 75 in liquid assets, in stocks. That's not a problem. You can't have more than 40% in real assets and private assets. That's not an issue. The only one that really takes some math to figure out to make sure you're in complete compliance with is that 20% international. That's my presentation. Some people call it rambling. Questions?
I've got a question on the investment policy on page 2. It's section 4.1C at the bottom. And if we're making changes to Exhibit A with the different asset allocations, would it make sense to change that last sentence? At the very bottom, it says, as of 1/1/24, the benchmark is, and it lists out the different percentages, but those have changed since then. Would it make sense to go ahead and update that sentence as well?
That is a broad 60-40 benchmark, 60% equities, 40% bonds. That benchmark does not specifically allocate to alternatives, and that's where the change was.
Okay.
So it was not based on your initial asset allocation. It was based on the world. If you invest as 60-40, if you're going to do this, you want to outperform a 60-40 portfolio over time.
Okay.
What may make more sense, or a better way to do this, if it's okay with you, is to have two benchmarks. We can do a 60-40, but then we can also do a second one specific to your allocation. And then it'll be up above or below it based on, frankly, how your managers do, and maybe how tactically you're overweight and underweight something as a particular time. So this one is broad. It's maybe too broad.
Okay.
If that's okay, we can add a second benchmark that's more specific.
I just wouldn't want to make the benchmark too specific, and then we have to go back and change the policy if we
Every
decide.
time.
Yeah, that would be my only concern with that. I like the idea of monitoring it against a benchmark that's perhaps just a little more realistic to what we're specifically doing. Mm-hmm. But I don't know if we want to modify the actual policy for reasons of that, which will lead into my question that's coming up.
Okay. Well, if that's the case, we can add a benchmark without having it in your policy. We can do whatever you want in the reporting. So why don't we do that, and we'll just document it as such.
It doesn't look like that really, 41C doesn't really say anything other than as of January 1st of 24.
That's what it was.
benchmark was this.
No.
It doesn't say it's got to outperform it, or it's got, it doesn't say any of those kinds of things. It's, I think that, if anything else, it just seems to me like if we're trying to think 50 years in the future here, when somebody's trying to look back at this, and we all kind of know what
the progression was.
Sometime in the future, if somebody's looking at this, is it even really meaningful as it is? And it really, honestly, it doesn't matter. You're giving us the benchmarks of what we have in here. I was just looking for Exhibit A. Richard, I don't mean to cut your question off, but since we're on this topic, where does it even refer to Exhibit A in the
The policy itself?
yeah, in the,
I'd have to look through it.
yeah, I'm trying, but I think probably what we ought to do is just leave you guys with the idea that, why don't we try to find that?
5.2.
Make sure it makes sense.
5.2, asset policy of the funds reflected in Exhibit A, date set upon.
Yeah, so maybe if nothing else, I would just kind of say, if we were going to make an adjustment to 41C, it would reference section 5.2 and say on an ongoing basis, because what we're doing is changing 5.2 when we make an allocation change, right? I'm trying to keep this straight in my head. I'm not sure if I am, but I think.
You're doing okay.
I think we're changing 5.2, and so maybe if we just reference 5.2 back there in 401C, that kind of ties everything together. I think it'd be important to keep 401C in place, because that does give the idea that somebody 50 years from now that, hey, the general idea was that we were trying to be about a 60-40 mix, right?
Yeah, basically, you consider that the broad market. You're attempting over time to outperform the broad market on a net of fee basis.
Yeah, so I'd hate to take it out.
No, I don't think taking that out, but somehow referencing or I like that 5.2 is in here, but referencing 5.2 up in 4.1C, I think makes sense for a specific, and then and so you don't have to change it every time. We'll change Exhibit A, and then we'll just change that second custom benchmark to match up with Exhibit A. And it'll be notated in your report, so you'll know where that came from.
Yeah.
Yeah, because the easiest way to track it, this Exhibit A has a asset allocation as of, and then we'll put the date in. It'd be a lot easier to just follow those dates on those exhibits as they change, instead of looking in the body like we're having to do now.
Yep,
So,
I agree with you. Good.
Richard?
I've been waiting.
No, this is easy. And you really teed this up, Tim. You brought it up earlier. You even said you're a conservative group. So I understand the last 3 years has been an anomaly, particularly with the S&P and some of the other things that are going on, the Mag 7s or whatever. But as a conservative group, or a conservative representative of what you dub to be a conservative group, just want to make sure that when you look at a double-digit return in a portfolio, when our policy is targeting a 7.5% return, I want to make sure we're calculating the risk we're taking on when events like today happen, where the Dow loses 1,000 points. I want to make sure we're not taking on more risk than we need to make sure that we are being that conservative group and prudently and properly managing our fiduciary responsibility. That's my concern, just from an alpha or beta standpoint. Are we in the right place that we need to be?
And it's a great question, because asset allocation drives 90% of your return. So you get rid of the manager names and just say, where are you at, and is that set up correctly? And looking backwards, when they say the last 5 years is the worst predictor of the next 5 years. So when we ran the asset allocation study in August, we came back and said, this portfolio, as you have now, we think is going to earn about 7.8%. We've run it 1,000 times, so you got that histogram, annually over a 10-year time frame. So 7.8, you've got a target of 7.5. So I don't think we're aiming too high. I think we have an appropriate asset allocation for what you're trying to achieve. We're not trying to hit 11.5%.
Perfect. That's what I was looking for.
You'd be 95% private equity. So I do believe the asset allocation is appropriate for what you're trying to accomplish.
Yeah, I'm comfortable with the 12%, knowing that there are perfectly obvious scenarios where we could be getting 18%, 25% in what's occurred in the last 24 months. I don't want to be there.
Correct, because
Make sure that we're not trending on that side of the pendulum versus the 7.5% side.
I was just getting ready to suggest, we go into a bunch of that emerging markets. That's what's best.
We're a conservative group.
Just kidding.
no, that's why you're diversified. So that when these things rotate, small cap picks up, you're there. Value picks up, you've got some value stocks. International picks up, you have some. So no, otherwise, Again, you want to make the most money, throw it in the all S&P or just throw it all in private equity and come back in 10 years and see how you did. That's not the right way to run a portfolio.
So I've got just a comment about this too. It's really all tied together, I guess, while we're on this page. First is really more in terms of your presentation from the beginning when we start talking about allocations. For my spot on this committee, I would suggest that if we're at 48% equities and 24% fixed income, whatever we are, where we're a little bit more in fixed income right now because we haven't gotten the other part.
Yeah, because Golub hasn't funded, correct?
I wouldn't call that, like you kind of started the presentation by saying we're overweight here and we're underweight here. To me, 1% or 2% here or there, if we're within these ranges, that's the reason these ranges exist. And I'm a little cautious. I mean, I would want to know, we're basically, are you just when you were saying that, were you just looking at this long-term policy
Correct.
percentage left-hand column?
Correct.
I think if we're within the ranges, it's not necessarily a discussion point in my eyes. I'll just kind of tell you. Unless you just think, hey, look, there's something out there that's going to create this on an ongoing basis, and we're within the range. I was really in the range situation. To Richard's point, I don't know that we have to go back and change the policy every time we make a 2.5% change, as long as it's within the range.
What you need to change is this Exhibit A. And the reason it's Exhibit A is because it's technically not part of the policy. So you could approve that without approving a whole new policy. That's what a lot of our clients do. And that's why it's not built into the structure of the policy itself, was so that you can change this so that you have a clear roadmap of what we're trying to accomplish without having to change the policy every time. The long-term policy, yes, it is the target. When we say you're in compliance with your investment policy, that's referring to the ranges, and you're within the ranges. Because you're never just going to be on top of that long-term policy. That's just luck or random statistics if you get there. But you absolutely want to be within those ranges.
So this long-term policy, I guess the name threw me off. I think what I would call that is a long-term target or something like that. Is that?
Target's a better word.
Yeah, because that makes me think, oh man, this is the policy, is this specific one number right here, and we're off policy. Mm-hmm. And given that this is a public meeting and there are other people listening to it, if they hear that we're overweight or underweight our policy numbers, it might throw up some antenna that don't necessarily need to be thrown up because we're within our policy ranges.
Okay.
Just something to think about on how we word that, I guess.
Yeah, if you're okay with this version, I can change more than comfortable changing policy to target. That cleans that up.
Because in 5.1 and 5.2, it says, it calls it a policy, so that would have to be changed if we're going to change it to a target.
Policy targets?
Yeah.
Okay.
Just
I'll
something
read
for you
through it
guys
and
to
adjust.
consider. I want to make sure that we're keeping the ranges as our real policy, because that's really what it is and what it needs to be, because it's going to just be impossible to keep it within a 1%, a one whole percentage point every time.
Yeah, those are our guardrails.
Yeah.
And to Mr. Applegate's point, since the text does refer to policy, I might suggest that we change range to policy on this Exhibit A, since that's really what we want to adhere to in the text of it.
Flip it, right?
Right.
Yeah.
Just make
Range.
policy range, and then long-term target. Something like that. Because it is nice to have a specific number. We can succinctly look at it and say, hey, look, this is about where we're supposed to be. But that target.
I would have to look at the semantics, but I tend to agree with counsel from the standpoint of if you just changed range over where policy is on this exhibit and policy where range is, it may catch the actual policy verbiage to show up here where it says long-term range and then policy. So the policy will become the range and the range will become the policy. I would lean on your expertise to advise on that.
We can certainly massage the language, make sure there's no other reference in here that'll, mess up the references.
I think we all understand the intent.
Yes, sir.
We'll do that offline.
Yeah, that'd be wonderful.
Yeah.
Yeah, it's a good idea.
Okay.
I'm sorry, that's a little bit getting into the weeds here, but just, I think, again, these are the kinds of things I'm thinking about in my head to try to set this up for future boards and however many years from now that this is going on and there's $500 million in it, it's going to be.
Carry these things down before it's an issue. Yes, sir.
Rick, is there any standard deviation to that? Like, is there any 1% grace? Like, would we ever have a timing issue where, say one of those categories moves 1% in and out of that target? Does there need to be language to have like, hey, a 1% standard deviation of a target range because of a timing issue, or does it always fall inside those thresholds?
It should always fall inside those thresholds. If it doesn't, it's my responsibility to come and inform you of that, and then you can tell me how to act, whether that's okay, waiting for a manager to fund or something, or if you can direct me.
By the way, Richard, for your comment, I'll tell you just my thoughts on this too would be that if there weren't a dollar cost averaging component of this, I'd be more worried about it in terms of hey, we've had 3 years of 90% or whatever the number is. You start having to be a little concerned about valuations or whatever. But we're still in the infancy stages of this thing. Frankly, it's for these purposes right here, we almost hope the market goes down in the next 4 or 5 months when we get the next payment. Because we're going to be buying. And then the next 16.
Almost.
I said it.
Almost.
All right, do we have any more discussion, any questions for Tim? Any more discussions about the policy? Do we need to take a motion on the investment policy changes, or?
I think it'd be helpful, yeah. Go ahead and take a
Subject
motion on that.
to council's review?
Right,
Okay.
right.
All right,
We've
so-
captured it all.
What's that?
We've captured it all, so we can just
Okay.
make a motion on the discussion itself to change the policy in accordance with the discussion, and then. go
Or do we
from there.
wait until the policy is presented and then make a motion to approve?
Well, we could. Our next meeting would probably, we want to do the next meeting before June, so we can adopt a budget. So we could wait until the next time and see what it looks like. Get that out early and let everybody take a look at it. We can wait until then.
Excellent.
Okay.
All right, thank you, Tim.
Thank you.
Thanks, Tim. Good work, man. That's exciting. 14 million is pretty cool.
Job's not bad when the markets are going up.
Good decade.
Marcus, make it easy.
All right, next on agenda, item number 4, it looks like we have the grant recommendations, and there's, inside of your notebook, there's a breakdown of the recommended organizations, the grant recommendations and the amounts. Do we have any discussion on those proposed amounts for entities?
I'll just make a couple comments. One, just to remind the board that the committee starts their work in October and works all the way through the holiday season to come out with the recommendations. So they put a lot of work into reviewing the grant applications. Carl Montgomery, the chairman of the committees, somewhere here is here. He can attest to that fact, but I know that they spend a whole lot of time on that, particularly during what's usually family time. So we very much appreciate that. I'm sure the board does. I know the council does as well. This year we did, kind of in keeping with Rick's comment of looking forward, this year the committee allocated almost $600,000, and it won't be long before it'll be over $1 million. And so to recognize that it gets harder and harder to give away bigger amounts of money, so we put in place some objectives analysis on the recommendations that come from the various committee members to try and assist in their decisions as they go through that, recognizing at the end of the day that doing what's in the best interest of the community is really what's guiding their decisions. But we backed it up with some statistical analysis on different recommendations and how they all work and some measures to come out with recommendations this year. So you have before you the packet of 30 different organizations to be funded. It's 20-some-odd% increase over last year. Kind of been keeping, and in the past few years, it's been about 29, 30 that have been funded. Different 29 and 30, not always the same on the past 2 years. This is the third year of funding. The statistics look pretty solid as we go through. So the past has been equal to what we've done this year. And in the future, we just want to keep it as consistent as possible. So if there's any questions, Mr. Montgomery can answer, or I can talk more about how we got to those numbers. It's all up to the board.
It looks like one entity that received funds was disqualified because they didn't file a mid-year progress report. And that, just one out of a big number seems like that it's probably not a hard thing to do, I would assume. Is that true, that it's a pretty simple process? It just requires them to input into a computer
The year
system?
prior, there was one that missed reporting as well, and the committee decided that if you're not going to follow the reporting requirements because they are not onerous, then you're not going to be eligible to get funds. The one that missed this year wouldn't have made the cut on the way it was done, but it did take them out early on.
Okay.
So they're not going to get it if they don't file.
If they sit out a year, are they eligible to reapply like the following year, or are they completely banned from
I don't
applying?
think I don't remember the discussion. They're not banned. I think it was just the next year.
Next year would be fine.
Yeah, they can reapply. Yeah, that was part of the discussion we had on how long they would be out, but I think it was decided it would just be this year until they would have to file and probably be watched very closely as we go forward to make sure they do hit their reporting, part of the accountability.
I need a motion for approval. I move approval of the recommendations for funding.
Second.
All in favor?
Aye.
Any opposed? Motion carries.
Okay, just a reminder, we'll take then your approval to council. Council gets one last brush at it. It's a up or down vote on the various recommendations. They don't get to modify it. They just say yes or no, and then it comes back to the board to decide what they do with it. But we'll do that over the next few weeks. Kevin usually goes with me to the council to get that approved. Last couple times, it's been straightforward, but we'll do that in short order.
Agenda item number 5, other business. I think Craig wanted to talk about insurance.
Yes, insurance, we did get a quote for E&O insurance, and Cincinnati agreed to renew our policy, and they were kind enough to lower our insurance by about a little over $600 on the premium. So it went down substantial. The year before, which was our second year of being covered, I think it was like a $3 increase, and this year it's a substantial decrease. So if the board's okay with that, we'll go forward and put that in place. I asked that it be bound, so it's being bound right now. They're checking on some other prices just to make sure the market hasn't shifted enough or it makes a difference, but they don't believe that that's the case.
You need a motion to approve that, or is it?
Yeah, it wouldn't hurt. I'll take it.
Second. All in favor?
Aye.
Opposed? Motion carries.
Yeah, thank you.
Do we have any other business that needs to be discussed? No. All right, future meetings, do we want to do it like we've been doing it, where we circulate some dates and everybody
Yeah.
checks a spreadsheet?
Yeah, we'll have city manager's office circulate some dates and survey and find whatever works for everybody to try and meet that late May timeframe. Well, maybe not late May. Aaron's
It'd
gonna
be
ship
great
it.
if we could do it in late April or early May at the latest.
Okay, late April, early May. Yeah. That way we can get our budget approved before
We submit the budget to council by May 15th, so that would include this budget as well.
Yeah, I stopped worrying about those dates.
I know.
I just blanked them out as soon as I possibly could.
All right, if we've got no other business, we'll call this meeting to adjournment at 4:54.
Great, thank you all.
Good.